You check your brokerage account during a market sell-off. The numbers are red, but that is not the worst part. The worst part is discovering that the investment you want to sell cannot be sold quickly, cannot be redeemed fully, or can only be exited after paying a painful penalty. Your money is still technically yours. You just cannot use it when you need it most. That is liquidity risk. Liquidity is your ability to turn an investment into cash quickly without accepting a major discount. During calm markets, liquidity feels invisible. During a downturn, it can become the entire story. Federal Reserve interventions in 2008 and during the March 2020 dash for cash showed how quickly markets can seize up when everyone wants cash. This is not a prediction that a recession or market crash is guaranteed. It is a review of 7 investments that can trap your money when buyers disappear, redemption requests rise, or your own household suddenly needs cash. Number 7 is a long-term certificate of deposit. A certificate of deposit, or CD, is a bank deposit that pays interest for a fixed period. Americans use CDs because the return is predictable, and deposits at an insured bank can receive FDIC protection within applicable limits. That addresses bank failure risk. It does not create instant access. A traditional CD may charge an early withdrawal penalty if you remove money before maturity. The penalty can consume months of interest and may sometimes reduce principal. The trap appears when your timeline changes. Maybe you build a 5-year CD position because the advertised yield looks attractive. Then you lose a job, face a major medical bill, or find that market rates have moved higher. Your money is not gone, but escaping the original contract has a cost. A CD produces interest and normally has very little day-to-day price volatility. But it is less liquid than a savings account, and interest is generally taxable outside a tax-advantaged account. The most vulnerable person is someone who treated emergency savings as investment capital. Monitor the maturity date, early withdrawal formula, automatic renewal rules, and whether partial withdrawals are allowed. What could make this warning wrong? A CD can be an excellent tool when its maturity date matches a known expense. A ladder, where different CDs mature at different times, can also improve access. Ask yourself, if my income stopped tomorrow, would I need this money before the CD matures? Number 6 is an individual, corporate, or municipal bond that rarely trades. A bond is a loan you make to a company or government entity. In return, the issuer promises interest and repayment at maturity. That sounds simple. Selling before maturity may not be. Stocks usually display a visible market price with large numbers of buyers and sellers. Many individual bonds trade less frequently. The price on your brokerage statement may be an estimate based on recent transactions or pricing models, not a guaranteed cash offer. In a downturn, dealers may widen the bid-ask spread. The bid is what a buyer will pay. The ask is what a seller wants. The gap between them is a hidden transaction cost. A bond showing a value of $10 may produce a much lower actual offer when you try to sell quickly. Credit risk also rises during a downturn. Credit risk is the possibility that the borrower may struggle to pay. Even before a default occurs, fear of one can push the bond's price down and reduce the number of willing buyers. These bonds produce interest and may work well when held to maturity, but taxes, call provisions, credit quality, and trading costs vary. The most vulnerable investor is a retiree who owns individual bonds for stability but may need to sell them early for living expenses. Monitor trading activity, credit ratings, the issuer's finances, maturity, call features, and the price a dealer is actually offering rather than the value displayed on the statement. What could make this warning wrong? If the issuer remains sound and you can hold the bond to maturity. Temporary market illiquidity may not matter. Ask yourself, do I have a maturity plan? Or am I assuming I can sell this bond whenever I want? Number 5 is a structured note. A structured note is generally a debt obligation issued by a financial institution with a return tied to another asset, such as a stock index, a group of stocks, an interest rate, or a commodity. The sales pitch often includes phrases like downside buffer, enhanced income, or principal protection. Naturally, the complicated part is in the footnotes. Structured notes can contain barriers, caps, call features, and formulas that change the outcome dramatically. Some notes are automatically redeemed early when certain conditions are met. Others can expose you to large losses if an underlying asset falls below a specified level. In 2026, FINRA intensified its focus on how firms recommend principal-at-risk structured notes, especially complex products linked to the worst-performing asset in a group. That attention exists for a reason. The liquidity problem is straightforward. Many structured notes do not have a deep public market. The issuing bank may offer to buy the note before maturity, but it may not be required to provide an attractive price. The estimated value after purchase may also be below what you paid because product costs were built in. The note may produce income, but that income can be compensation for risks you do not fully see. You also face issuer credit risk, because a promise is only as strong as the institution making it. The most vulnerable investor is someone who hears buffer and mentally translates it into safe. Monitor the underlying assets, barrier levels, maturity date, call provisions, issuer creditworthiness, fees, and whether a real secondary market exists. What could make this warning wrong? A carefully selected note held to maturity can deliver the result described in its prospectus. The problem is not that every structured note is defective. The problem is buying a complex payoff with money you may need early. Ask yourself, can I explain exactly what happens if the market falls 10, 20, or 40%? Number 4 is a non-traded REIT. A real estate investment trust, or REIT, owns or finances income-producing property. Publicly traded REITs can be bought and sold on an exchange. Non-traded REITs are different. They may offer real estate exposure and regular distributions without the daily price movement of a listed stock. That smoothness can be comforting. It can also be misleading. A non-traded REIT does not have continuously traded market price. Its reported net asset value may change less often than public market prices. That does not mean the buildings avoided the downturn. It may mean the valuation process moves slowly. Redemption programs can also have limits. When too many investors request cash, the fund may fulfill only part of each request, delay redemptions, or apply restrictions allowed by its documents. That is a gate. A gate is a rule that limits how much investor money can leave during a period. Rent can support distributions, but high rates, vacancies, refinancing pressure, taxes, insurance, and fees can weaken cash flow. The most vulnerable investor is someone who views the regular distribution as proof that the principal is stable. Monitor redemption limits, debt maturities, property types, occupancy, leverage, valuation methods, fees, and whether distributions are supported by operating income. What could make this warning wrong? A diversified real estate portfolio held for many years may recover from a downturn and continue producing income. Illiquidity can even prevent emotional selling. Ask yourself, if redemptions were restricted for a year, would my household still be financially comfortable? Number 3 is an interval fund. An interval fund is a registered closed-end fund that generally does not trade on a stock exchange. Instead of allowing daily redemptions like a traditional mutual fund, it offers to repurchase a limited percentage of shares at scheduled intervals. That might be quarterly. It might not be enough. Under the structure used by many interval funds, the fund offers to buy back only a portion of outstanding shares. If investors submit more shares than the fund agrees to repurchase, requests can be prorated. Prorated means you receive only your proportional share of the available redemption amount. You could request $50 and receive access to only part of it. Interval funds often own private credit, real estate debt, or other hard-to-sell assets. You accept less access for potentially higher income. The danger is a mismatch. The fund gives investors periodic liquidity while owning assets that may become even less liquid during stress. Fees can also be higher than those of ordinary index funds. Income may look attractive, but a large distribution does not eliminate credit losses or valuation risk. The most vulnerable investor is someone who treats an interval fund like a bond fund with a slightly better yield. Monitor the repurchase schedule, percentage offered, proration history, portfolio holdings, leverage, credit quality, expense ratio, and distribution coverage. What could make this warning wrong? If you truly have a long time horizon and understand that access is limited, an interval fund may provide useful diversification. Ask yourself, is the higher yield paying me enough for surrendering daily liquidity? Number 2 is a private real estate syndication. In a syndication, investors pool money with a sponsor to buy an apartment complex, storage facility, office building, or other property. The sponsor manages the deal, arranges financing, and decides when to refinance or sell. The projected return may look precise. The exit date usually is not. These investments can require a multi-year holding period. There may be no organized secondary market, and transferring your interest can require sponsor approval or a buyer willing to accept a substantial discount. During a downturn, property income can fall while refinancing becomes more expensive. A loan that looked manageable when the deal began can become a serious problem when it matures. Then comes the capital call. A capital call is a request for investors to contribute additional money. The sponsor may need cash for repairs, debt payments, or lender requirements. You may be asked to invest more precisely when your other assets and income are under pressure. Fees can include acquisition, management, financing, construction, and profit-sharing charges. Tax reporting may also involve a Schedule K-1. The most vulnerable investor is someone who invested because a projected internal rate of return looked impressive without studying the debt. Howard Marks has repeatedly emphasized that risk becomes clearest when conditions turn difficult. In private real estate, the downturn reveals whether the deal was supported by durable cash flow or optimistic assumptions. Monitor loan maturities, variable rate debt, occupancy, sponsor experience, cash reserves, capital call provisions, fees, and the exact process for selling your interest. What could make this warning wrong? A strong property, conservative financing, and capable sponsor can perform well over a long holding period. The investment may never need emergency liquidity. Ask yourself, can I afford to receive no distribution, contribute more money, and wait several additional years for an exit? Number 1 is a highly leveraged rental property. This is the investment that looks the most tangible. You can see the building, you can collect rent, you can tell yourself that people will always need somewhere to live. All true. But a rental property financed with heavy debt can trap both your cash and your choices during a downturn. The property requires cash for the down payment, closing, repairs, insurance, taxes, and maintenance. Then a vacancy or major failure arrives. Meanwhile, the mortgage still arrives every month. Leverage means borrowed money magnifies outcomes. If the property rises in value, your equity can grow quickly. If the property falls in value, a relatively small price decline can erase a large share of your equity. Selling is expensive. Commissions, concessions, repairs, taxes, and closing costs add up while weak market buyers demand discounts. Refinancing may not rescue you. If rates are higher, the new payment may be worse. If the property value falls, the lender may not approve the loan you expected. Cash flow exists only after vacancies, repairs, management, taxes, insurance, and debt service. Gross rent is not profit. The most vulnerable owner is someone whose personal emergency fund and property reserve are the same small pile of money. Monitor local employment, vacancies, rent collections, insurance, property taxes, major repairs, loan terms, equity, and the number of months you can cover the property without rent. What could make this warning wrong? A rental bought at a reasonable price, financed conservatively, and supported by healthy reserves, can remain productive through a downturn. Long holding periods can help absorb temporary weakness. Ask yourself, if rent stopped for 6 months and the property value fell 15%, could I hold without damaging the rest of my financial life? All 7 investments share the same hidden assumption. You believe you control the exit, but the contract may control the exit. The fund may control the exit. The sponsor, bank, dealer, buyer, or lender may control the exit. Benjamin Graham taught investors to focus on the difference between price and value. During a downturn, you also need to focus on the difference between value and access. An investment can have long-term value and still fail your household if it cannot become cash when the mortgage, medical bill, or tuition payment is due. Before buying anything with a lockup, redemption limit, surrender cost, thin market, or large transaction expense, calculate your liquidity budget. How much cash do you need for emergencies? How much could you leave untouched for 5 years? What happens if income falls at the same time the investment declines? And who has the legal right to tell you no when you request your money? The goal is not to avoid every illiquid investment. The goal is to avoid discovering your time horizon during the crisis. Because, in a downturn, the investment that hurts most may not be the one that falls the farthest. It may be the one that refuses to let you leave. This content is for general education and is not personalized financial, tax, legal, or investment advice. Consider your time horizon, liquidity needs, debt, taxes, fees, and risk tolerance before making financial decisions.